Hello, welcome to another episode of the Capital Employed podcast. Joining me in conversation for this episode was Jonah Lupton. In this episode, Jonah provides an overview of his investment style. He also talks about two companies in his portfolio that are growing revenues at a rapid pace and could potentially be 5x, possibly even 10x multi-baggers. Exciting stuff. I really enjoyed listening to him and I think you will too. Before we jump into this episode, do make sure to add your email to the Capital Employed email list. We will be publishing some exclusive interviews that will only be available to those on the list. To receive these bonus episodes, please visit capitalemployed.fm/exclusive and add your email to the list. Okay, please enjoy my conversation with Jonah. Hi Jonah, thanks for coming onto the podcast.
Thanks for having me.
I've been onto your website and you're involved with so many projects. I didn't know where to start, so could you provide an overview of what you do?
Yeah, so right now I'm mostly focused on my Substack newsletter, which is my weekly deep dive analysis on different companies. I also run a stock twits room where I post a lot of my buys and sells, my daily commentary, any stocks that I'm, particularly interested in and starting to do some due diligence on, basically trying to help retail investors do a better job at managing their portfolio. And then I also created a company called Fintrix. It's really a product that's based on fundamental analysis. So myself and my developer built this complicated, valuation model to try to help retail investors determine fair market valuation for their companies and where these stocks should be trading in 12 months based on the fundamentals. So those three things are taking up most of my time right now. I'm trying to think what else I'm doing. I think that's pretty much it. It's really those three things. Oh, and then I do a lot of interviews with CEOs. So, because my investment strategy is primarily small cap, mid cap growth, these are the types of companies that investors are not overly familiar with, and they don't get a chance to, hear from these CEOs on CNBC or Bloomberg. So I'm using this as an opportunity to interview these CEOs so that they can talk to retail investors about what they're doing, how they're building their companies and whatnot. So when you turn on CNBC, you see a lot of interviews with the, big time Fortune 500 CEOs of companies like McDonald's and Bank of America and Boeing. You don't see a lot of interviews with CEOs of companies under 5 billion market cap. So that's where I've kind of plugged myself in.
Yeah, I'm subscribed to your YouTube channel and the content is excellent. Yeah, I really enjoy it. For your investment style, what type of businesses do you like to invest in? What characteristics are you looking for?
So I'm definitely a growth investor. I'm only 40 years old, so I'm still on the younger side. I have a couple decades left till retirement. So I just believe the best way for me to at least outperform the indexes and maximize my returns over the next 10 or 20 years is to invest in the most disruptive companies that I can find. With that disruption typically comes growth, but not all growth is the same. I am cognizant that, there's different layers of growth or different types of growth stocks. You have the more mature growth companies out there like the Amazons and the Facebooks and the Microsofts. They're still growing at 15, 20, 25% a year, but they're very, very mature. They have great margins, strong cash flows, incredible balance sheets, but those companies have already seen their hyper growth. And then you have like the next tier down, which is your 100 to your $250 billion companies. That's your Squares, NVIDIA, Adobe, Autodesk, Salesforce, those types of companies. Once again, their hyper growth days are behind them. They're more mature. Now they're growing at probably 30, 40%. I am looking for those hyper growth companies. I'm looking for the stocks that are growing at least 50% a year, and that's for the next 2 to 3 years. But most of my companies should grow at least 80 to 100% for the next 2 or 3 years. So right now in my portfolio, I have 20 stocks ranging anywhere from 40% annual growth to 500% annual growth. Now, the companies that are growing at 500%, that's not sustainable, obviously. That's a company like Desktop Metal, that is really just getting into their revenues now. They're launching these massive 3D printers, and they're shipping their largest units this year, which is why that revenue is spiking. That hockey stick growth. But across my 20 stocks, the average company in my portfolio should grow revenues at about 145 to 155% this year. So I'm looking for stocks with market caps under 10 billion, with growth rates above 50%, that I believe have a very good chance at 5xing over the next 5 years. So, we call that a five bagger. So a five bagger over the next 5 years would equate to a 38% compounded annual growth rate. So I'm trying to build a portfolio of 15 to 25 stocks that I believe each one of them could be a five bagger over the next 5 years. Obviously, some of them will not hit that mark, and then some of them will. I think most of them will. And then several in my portfolio will probably end up being 10 baggers or maybe even 15 baggers over the next 5 years. So my goal is to run a diversified portfolio of growth stocks that I think I can achieve, at least a 25 to 30% annual return over the next 5 years.
How do you look at the valuation?
It is very difficult to value some of these growth stocks. One way is you can, try to find a comparable stock or company in their sector and try to compare multiples that way. Another way to do it is you can build financial or forecasting models. We call them DCF models, discounted cash flow. And you can build these models that go out 3, 4, 5 years, try to predict what the revenues might be, try to predict what the gross margins might be, the EBITDA margins, the net income margins, apply a, risk-free discount. And then that'll kind of give you an idea of what the current, fair market valuation for that stock might be, meaning, what should you be willing to pay for that company now, assuming that it hits those numbers, what it can be worth in 3, 4, 5 years. So I do have a 5-year model for each of my core holdings. There's probably a couple stocks in my portfolio that I haven't done a full 5-year model on yet, partly because a lot of these smaller, younger, high growth companies that are just coming public now or in the past year or so, and they're just starting to hit that big ramp up in revenues, it's really hard to know where revenues might go in 3, 4, 5 years. I mean, there's a lot of things that could go right, could go wrong. And it's very hard to try to predict the next 3, 4, 5 years of revenues until you see these companies operate for, 2 quarters, 3 quarters, 4 quarters to see if they're actually able to hit their expected numbers. So, but at least for my core holdings, my top 10 holdings, I do have a 5-year, forecasting or financial model for each of those stocks, with revenues and margins. And that's why I feel so comfortable continuing to add to these positions right now, because I believe I have a good idea of where these stocks could be trading in 3, 4, 5 years if the stories unfold the way that I think they are. But, in the old days when I first got into investing 20 years ago, you didn't have a lot of companies growing this fast. Software companies didn't really exist. There was no 3D printing. There was no electric vehicles. I mean, a lot of industries that are very strong right now didn't even exist 20 years ago. And this was just after the dot-com bubble, where a lot of investors had gotten burned on these supposed high growth companies, these internet stocks. So back 20 years ago when I got in, which was 2002, most investors were only investing in companies that had proven revenues and earnings, and you were valuing these companies on price to earnings multiples. But nowadays, when there's a company that's supposed to grow at 150, 200% for the next 4 or 5 years, they're not going to be profitable yet. They need that runway in order to ramp up their revenues, launch new products, take market share, build the team, etc. These companies are going to lose money for the next 2 or 3 years as they, scale up the business. And not every investor is willing to take that ride. I am for a large portion of my portfolio. So I kind of break up my portfolio into 3 pieces. I have like the real high growth, high risk stocks, slightly slower growth, more mature companies that are already profitable. And then, somewhere in the middle, companies that are growing at, 100%, and maybe they're only 1 or 2 years away from, finally being break even or profitable. But you see a lot of investors nowadays using price to sales multiples to value these younger, higher growth companies that don't have any earnings yet. It's tricky. Every investor needs to figure out what works for them.
Can you talk us through two stocks in your portfolio that you're really excited about, you think have good long-term potential, and what was the thesis for investing?
One of the stocks I definitely would have talked more about in detail is Upstart, because it was my biggest holding up until a couple of weeks ago. Actually, it still is my biggest holding right now, but this is an AI-powered kind of software lending company. So they don't take any credit risk themselves. Essentially, what they did was built a better underwriting model compared to the traditional FICO scores. So most banks, 99% of banks out there, are using FICO scores to determine an applicant's or potential borrower's creditworthiness. Upstart decided 8 years ago that was ridiculous, that there's so much more information and data out there that should be used to determine someone's creditworthiness, that they built this very complex model based on 1,600 data points per applicant. And over the last 8 years, they've essentially gathered 16 billion data points. Hundreds of thousands of loans have now been processed through Upstart software. And every time a loan is issued or denied, or payments are made or payments are missed, all of that is helping this model become smarter and smarter and smarter. That's the power behind AI and machine learning. I've understood this company pretty well since they came public in December. I did a Substack write-up on the company when the stock was trading in the high 30s. It was my second largest position coming into 2021. And the stock went from 40 to 100 within a couple months, and then sold off all the way back down to 55. And then they reported great Q1 numbers and raised guidance for the year. So the stock rallied from 55 all the way up to 165. I think it was like in 3 or 4 days, the stock literally went up 3x. And then it pulled all the way back down to around 100. And then they reported phenomenal Q2 numbers. And the stock actually reacted negatively. A couple weeks ago, the stock got down to 82. I doubled down on it in my portfolio, which usually means that I'm selling some of my lower conviction positions. So, I'll go trim off 2 or 3 of my smallest positions in the portfolio and add to, one of my higher conviction names, in this case, Upstart. And then over the last week and a half, Upstart literally went up 100%. It went from 81 or 82 all the way up into the 160s yesterday, where I started trimming the position back. So, it's been an absolute home run for me this year. And this is just the very beginning for a company like this, because if you think about the size of the credit markets, they've only been doing personal loans up until now. They're now just getting into auto loans. They actually acquired a company called Prodigy, which builds software for auto dealers. So that will help them, accelerate this process to get into auto loans, because it'll enable them to build relationships with auto dealers and then have their AI software kind of plugged into the lending portion of the checkout process for customers at auto dealers. The CEO of Upstart calls this Prodigy software the Shopify for auto dealers. So that's a good way to think about it. A very seamless process for customers when they walk into an auto dealership. They can now get an iPad and basically go through the entire customization and checkout process. I love everything that Upstart's doing. Phenomenally smart team. They're hiring tons and tons of software engineers and computer scientists, PhDs, AI and ML experts. So it's a top 3 position for me right now, even after trimming 25% of my position over the last 2 days. Not because I've lost any faith in the company, just because the position size got way too big for my portfolio. So Upstart is still one of my favorites. I actually wasn't going to talk about it in that much detail because it's up 100% over the last week. And, what was a great entry price a week and a half ago in the 80s, I wouldn't go running into the stock right now in the 140s. Although, like I said, yesterday the stock ripped up to about 163, 164, and then pulled back throughout the day into the low 140s, as clearly there was some profit taking going on. So definitely would not have been a buyer of the stock in the 160s, but after that 20% or so pullback, I think it looks pretty interesting now back in the 140s. I think this is probably a $200 to $240 stock in the next 6 to 12 months. So that's one. So another one that I still love that I actually did a Twitter thread about today is Celsius. So this is an energy drink company that people might be familiar with because they've been getting a lot of exposure across social media recently, but also because they've done a great job of growing their store footprint. Energy drinks is a pretty competitive space. I don't think it's quite as competitive as people think it is. There are a lot of brands out there, but there's a limited number of brands that actually get shelf space, which is really all that matters. At the end of the day, if you're not on the shelf or you're not in the cooler, you really don't matter. Right now, the two big energy drink companies out there are Red Bull and Monster. They probably account for half of the industry. The total addressable market right now for energy drinks is 60 billion and growing at 9 or 10% a year. So this will be let's call it $100 billion market in 5 to 6 years. Right now, Celsius has about 1.2% market share of the US market, but I see that growing to probably 3 or 4, maybe even 5% over the next 5 to 6 years. So what they've done over the last year is just incredible job of execution. They were primarily they call themselves like a functional fitness beverage because it's a much healthier version of an energy drink that actually has vitamins and other nutrients in there, electrolytes and whatnot, versus your traditional energy drink like Monster or Red Bull, which is basically just a bunch of chemicals and artificial flavors. So since Celsius started, they really wanted to be known as the healthier energy drink. And because of that, when they first launched, many years ago, their focus was on the fitness channel, meaning gyms and fitness studios and whatnot. And that's kind of what they were still doing up until the pandemic started. They had some retail distribution, meaning, grocery stores, big retail stores, gas stations and whatnot. But they were, gym and fitness was still their primary channel. And then the pandemic started. A lot of retail obviously got shut down. They really put more focus into e-commerce. Amazon became a really strong channel for them. They're actually the number 2 energy drink on Amazon, which is pretty incredible. They're actually ahead of Red Bull on Amazon. The only energy drink company on Amazon that's ahead of them is Monster, and they are quickly catching Monster. They're probably still a year or so behind, but I could see them surpassing Monster at some point. But back to distribution. So I don't know the exact store count when the pandemic started. My guess is it was probably in the 30, 40,000 range, but they ended 2020 at 82,000 stores. They ended Q1 2021 at 92,000 stores. So that's phenomenal growth. 92,000 stores right now carry Celsius, and that's including Walmart, Target, Costco, Kroger. Most of your big grocery stores, CVS, Walgreens, Speedway, a lot of your big convenience stores and gas stations. And that's actually the largest channel for grab and go. So convenience stores and gas stations is where people, what I call grab and go, they're looking to pop in, fill up their gas tank, run in, grab an energy drink, and they want that drink cold. They don't want to be grabbing a warm energy drink off the shelf. So what Celsius is in the process of doing is putting these branded coolers, that are probably, I don't know, I'd say 2.5 to 3 feet wide, probably 6 or 7 feet high, 3 or 4 shelves in there, and putting those coolers into, some of the, what they call, the highest sales velocity locations, where people can, grab and go a cold Celsius, 1 or 2 cans at a time. But I would say the biggest thing that they've done, besides 92,000 stores, besides these branded coolers, they're in the process of transitioning from DTR to DSD. And what that means is, so DTR is direct to retailer, which means, let's say you're a grocery store in Wisconsin and you're running out of Celsius, you place an order for Celsius, Celsius ships the pallets or the order to the distribution center or the warehouse for the retailer, and then it gets shipped to the store, and then the employees have to stock the shelves. late last year, because I've been such a big fan of Celsius, people were tweeting me pictures of their local stores completely sold out of Celsius. They would go in there at like 2 o'clock in the afternoon and the shelves would be empty. And that's because the employees were not stocking those shelves fast enough. Now they're transitioning over to DSD, which is direct store delivery. And that means that they work with these regional partners, their DSD partners, that deliver the stock themselves, deliver the product themselves to the stores, and they're responsible for keeping those shelves stocked all the time. And that is a huge transition for the company. I mean, that's how the big boys do it. That's how Coke does it, Pepsi does it, Monster, Red Bull. They all work with DSD partners. And, because recently Bang, which is another big energy drink, went and did a distribution deal with Pepsi, they ended up leaving all of their DSD partners. And those DSD partners then came to Celsius and have now partnered with Celsius. So Celsius is now working with a lot of the DSD partners that helped Bang grow to where they are today. So the story it's really interesting if you dive in and actually try to figure out the business model and why they're growing and what the growth strategy is. It adds up to something that's pretty exciting and something that I posted on Twitter today, which hopefully a few people listening have already read. So Nielsen Data, that's the scan data that CPG companies use to determine year over year, sales velocity. Q1 Nielsen data for Celsius was tracking around 100%. When Celsius reported Q1 numbers, they reported 101% year over year growth in US operations and then 25% in international. But now in Q2, those numbers are way up. So in April, the Nielsen scan data was tracking at 200%. I am expecting a monster Q2 from Celsius because even if that scan data goes from 200% year over year in April to 180 in May and 160 in June, you're still looking at 180% year over year scan data for U.S. operations. And because U.S. operations was 78% of total revenues in Q1, these bigger numbers would easily get that over 80%, as the U.S. international mix. If international grows at, let's say, 40% year over year, so you have 180% for U.S. as 80% of operations, and then 40% for international, 20% of operations. I mean, you could be looking at 140 to 150% year over year number for Celsius. And right now the estimates are 76% year over year growth to 53 million. So I think Celsius is setting themselves up for a monster Q2 number. So we'll see. There's still, what are we, end of May right now? So I'll probably see that Nielsen data in the next few days. Celsius doesn't report Q2 numbers until August, but I'm adding to my position right now because I see Q2 setting up as a complete monster quarter for the company, assuming they can get through this aluminum can shortage. So there actually is an aluminum can shortage on the planet, which is crazy because I just never thought that would happen given, how much recycling is now done by people and towns, but it's true. I mean, there is a legit aluminum can shortage. I think it's because a lot of people have stopped eating and drinking in restaurants, and now they are, they're consuming more cans. Think about all the people that used to go into bars and drink at bars, out of glass bottles or, actual glasses, because of draft beer. And now all of those people are sitting at home drinking cans. I think that's kind of what's led to this can shortage. Plus the global supply chain and logistics is just totally messed up everywhere. I've seen that across multiple companies where, there's shipping delays and the ports are backed up. But we'll see. Assuming Celsius can get through the can shortage, I think they're in a great position for a really big Q2 number.
Yeah, I didn't realize there was that shortage going on. Yeah, thanks, Jonah, for sharing those two companies. They're both very exciting. Where can our listeners go to find out more about you?
I'm very active on Twitter. That's probably the best place to find me. So my Twitter handle is just my first name and last name put together, Jonah Lupton. And then if you go to Twitter, in my bio, I have links to my Substack and my StockTwits room. So if you want to get my weekly write-ups or, you want to join my daily trading room, the links are right there for you.
Okay, that's great. Yeah, thanks so much, Jonah, for coming on to the show. It's been great listening to you. Maybe we can get you back onto the show a bit into the future with some more stocks that you found.
Absolutely. Love to come back anytime. Thanks for having me. I appreciate it.